The average Social Security payment today in the United States of America is around $1,800. If they never change CPI,
it would be like 11,000.
It'd be 11,400.
That's insane.
That's how much that the quality of life and standard of living has been robbed from American retirees. Completely robbed to the point where you should be getting 11,400 a month, and if you're lucky to get the average, you're only getting 1,800.
But it kind of like makes sense if you compare the prices of today's things to what it was back in the day, right? I mean, you got so much more bang for your buck. You know, one guy on a factory job making $50,000 a year, it was like a house cost like $50,000 a year. Exactly. It was like, you know, that salary could buy you a house.
Exactly. Now you can't do that. And what's so sad about it is, and what's amazing is, if this were the case today, then Social Security alone, this year in 2024 alone, just 1 year of Social Security would cost $9.9 trillion.
Wow.
Our entire budget is around $7 trillion. So imagine if we had Social Security at 9.9 plus the rest at 7, we'd be spending $16 trillion.
Yeah.
So now you start to understand why the government is incentivized to control CPI, because it filters down into very important things, and it lowers their costs. It lowers the amount of money they need to print, but they're stealing from the American people. That's not the government's money. Social Security is taken from our earnings, and that's our money, and they're diluting it at an extreme pace. Only Bitcoin can protect us from that.
It's kind of crazy. I mean, you know, I think one of my guests the other day made the point that, like, you know, we got to figure out a different way to come at these entitlements. You know, and I know it's super unpopular, but like, if they just, instead of doing all this Social Security payments and all this, if they just like took somebody like the day they were born and like just, you know, put like $1,000 worth into like the stock market and $1,000 worth into like Bitcoin. You know what I mean? Like 70 years later or 50, 60 years later. I mean, some kind of version of a solution like that would be like, it's like seeds a tax account that grows for like, you know,
see,
50,
so now I can
years.
finally answer your question. What is People's Reserve? What do you guys do? What the hell's going on over here? Your website sucks. I can't find it.
I tried to go to the website, man. I'm not gonna lie. I couldn't really navigate. It was just
it's a gift.
Reserve. Yeah.
You're not supposed to know.
You got all these other websites that work, but the People's Reserve website doesn't work. What's going on?
So, look, Bitcoin bonds are a hybrid debt equity product, and they do exactly what you just said. They combine U.S. Treasuries with Bitcoin, and it's a principal protected note. So it's a structured principal protected note with exposure to treasuries and Bitcoin. But what happens is when you do this, not only does it unlock access for corporations and companies whose regulations and policies are keeping them from holding spot Bitcoin and self-custodying Bitcoin or even using a custodian.
So this is like a workground, kind of like what Sailor's doing. It's like a glitch.
Yes.
Like a glitch in the matrix.
Because when they buy a Bitcoin bond, they're buying debt. They're not buying Bitcoin. So when the rating agency looks at it, they're looking at an unrated bond. They're not looking at Bitcoin. Doesn't matter what's in that product. Doesn't matter. It matters what the product is. And when you combine a principal protected note with a certain structure, it's a principal protected note. It's a debt note, and a debt note, an unrated debt note, gives you a certain amount of ability, especially for an insurance company, to use on their balance sheet to write liability against. So if they buy Bitcoin, they can't add any more customers. But if they buy a debt note with exposure to Bitcoin, the rating agency doesn't care. It's a debt note. They can write liability against it.
So this is super useful until they can just hold directly Bitcoin and get liquidity off that, right? Is that the idea?
I think the answer to that is actually no, because now we're talking about the performance of the note, because the reason you get to write leverage against a debt product is because the volatility is low. So it's not, Bitcoin's volatility is not going to change. So when something's super volatile, you can't write a lot of liability against it, right? Imagine an insurance company bought $100 million of Bitcoin. Then we have a hurricane, and $200 million of claims are coming in. But we're in the middle of a bear market, and the $100 million Bitcoin is now only worth $20 million Bitcoin, or 30 or 40 or 50 million.
Okay.
You get that 40, 50, 60% pullback, and that hurricane just happens to hit at that time.
Yeah.
It doesn't matter if it's Bitcoin. It doesn't matter if it's any other asset that's volatile. Any volatile asset is not going to be able to, it's not going to enable the owner of that balance sheet to write a liability against it. You need to eliminate volatility. So I don't think Bitcoin volatility is going to slow down anytime before 2140, anytime before this. The schedule's done. So we
hasn't volatility like come down over time? Like every cycle, it gets a little bit less. We get a little less volatility. I mean, it's still super volatile, but
we're less volatile to the upside. So we have this diminishing return theory, which I think is going to get put to rest, because when we go from 100,000 to a million, with the monetization. The monetization of Bitcoin will move us away from the commodity cycle. The commodity cycle worked the exact way you thought it would, with volatility to the downside there all day, every day to the cost of production, but then volatility to the upside dampening, because the more market participants there are, the lower those profit. Like the OGs like yourself in the beginning is like, man, I got 400% premiums on my Bitcoin mining. I don't care. I'm not selling this. Like, who cares? But now we have publicly traded companies that have a fiduciary responsibility to lock in those profits. Yeah. So the level of selling at that margin is higher, and it diminishes those returns in a commodity cycle, which is actually supposed to be happening. And then that profit is reinvested into expanding supply. We can't expand supply. And now you have diminishing returns moving with a higher cost of production. You're going to create this little cross. And when we hit that cross area, that's when price will go above hash rate. That's what I was saying earlier. Like right now, price is trying to catch hash rate. After the monetization of Bitcoin, hash rate's going to be trying to catch price. And we're going to flip flop. And that dynamic.
Can you explain? Because I've lived in this commodity cycle for, since I've been here. Explain what this monetization of Bitcoin looks like. Explain what you mean by that. Like, let's unpack that a little bit for our listeners.
Yeah. So I think it's the complete integration of Bitcoin into not only money systems, but into finance through debt products. So I think what Michael Saylor's doing with his corporate bond is very interesting. Of course, there's a lot more. There's so much nuance, right? The reason that there's not one central bank in the world is because no one central bank could control everything. So it's all bifurcated. No one company can control or service the entire world. So that's why Michael Saylor understands this. This is why he goes and teaches Microsoft. Some people would be like, why are you teaching them that? Aren't you afraid they're going to do it better than you or something like that? But he's the innovator. So they're playing catch up with him all day, every day. And people are going to be playing catch up with People's Reserve all day, every day, because they're copying and they're imitating. And it's a form of flattery, but they're not innovating. Michael's innovating. We're trying to innovate at People's Reserve. And when we integrate Bitcoin into the money system, into these debt products, especially the Bitcoin bond, because we will dive into self-repaying mortgage, but with the Bitcoin bond, it's a principal protected note, meaning I can go into an insurance company and say, how bad do you want exposure to Bitcoin? And they'll sit there and say, we'd love to own Bitcoin, but it doesn't fit into our business model. There's regulations that are going to prevent us from holding it anyway. And even if we could hold it, we can't write leverage against it. So it just doesn't make sense. It's too volatile for us. But hey, on a personal level, I'm invested. I believe in this, but I can't do this with this company. It's just not where we need to be.